And Abigail, I'm taking a look at the VIX. It's down on the day, but still above 20.
It is. It just flipped right above 20 moments ago. Romaine, it had actually been below 20. And 20, as you know, symbolizes that there's less complacency from a longer-term perspective. VIX at 20, that's basically where you want to see it. Now, when we see VIX at 20, some concern for some investors might creep into the picture. Scott Bauer, CEO of Prosper Trading Academy, you are a true expert on VIX. One time, about 2 years ago, you took us through the math on it. So we have had VIX go from basically 15 to last week, it was as high as 23, certainly elevated, but to Romaine's point, on the day down, and the S&P 500 up ever so slightly right now, testing its 200-day moving average. How do you put all of this together, bullish or bearish?
You know, overall, I would say I am moderately bullish, not bearish is maybe a better description. And here's the reason why. Especially when looking at the VIX, Abigail, the put-call ratio in the VIX is typically inverted. So what we would normally see, you know, in equity put-call ratio is 1-to-1, maybe a little bit higher than 1-to-1. In the VIX, what we're seeing is normally about a 0.4 to 1, meaning that there's about 2.5 calls for every one put that trades, and that would be, you know, inverse to the regular regular markets, because calls on the upside in VIX means people want protection of the market going down. Well, recently, what we have seen is that flip, and we're seeing a put-call ratio now almost 1-to-1, which tells me that people are right now, retail anyway, not really expecting the VIX to go that much higher in the near term.
Okay, so that's retail. Last week, though, we did have that VIX curve inverted slightly, so a little bit of backwardation. And so when that happens, if it gets deeply inverted, basically the VIX index itself is above futures, which would suggest that there's more uncertainty around the moment, the near term, than there is further out, which is a little bit not the way it should be. Is that of concern to you? And especially, again, you have this S&P 500 kind of below, right around that 200-day moving average. The Russell 2000 well below it. Oil looks, it has not happened yet, but it looks like it could break to the downside. It looks as though we could see some more selling in risk assets, but you're not really seeing many signs of that?
I'm really not, but you're right. You have all of these factors coming together. And don't forget, not only the big earnings this week, but we've got the Fed next week. So you have got so much of this dynamic all coming together that really is just ripe for a risk-off scenario, but I'm just not seeing that in the VIX trading. And when I look at some of the individual equities also, if we throw out some of the stocks that have earnings this week, individual equity implied volatility is actually not that high, Abigail. I would have expected it much higher than it is right now.
I forgot all about the Fed next week. It's amazing how that November meeting is all of a sudden going to be here. Scott, you do of stocks that could potentially be going higher. You like the big banks. Talk to us about JP Morgan in particular.
I really like JP Morgan. I think the banks, as many of sectors, are really oversold. But when we get in a period of time like this, I really want best in class. And JP Morgan, to me, is best in class. It's also right down near its 200-day moving average. So technically, the fact that it's oversold. So I really like some upside here. I'm buying November regular calls. So November expiration, the 145 calls, you can buy those for about $2, $2.25. I really think we're going to see a pop here in JP Morgan.
Nice way to play that potentially. Scott Bauer, CEO of Prosper Trading Academy, thanks so much for joining us, as always, for Options Insight. And from New York, this is Bloomberg.